Good morning. This is Bloomberg Daybreak Europe. I'm Kriti Gupta in London. Let's get to the stories that set your agenda. Powell keeps the party going. The S&P 500 hitting another all-time high as the Federal Reserve maintains its outlook for 3 U.S. rate cuts this year.
If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
That puts the focus now on Europe. The Bank of England, the S&B, and Norges Bank all set to deliver policy decisions later today. We're going to walk you through that, plus the market reaction. And on top of that, I'll be speaking to the World Trade Organization's chief economist. That interview with Ralph Ossa coming up this hour. Let's get a quick check on the markets in the meantime, because, look, there's a lot to digest. I mentioned those record highs that you saw in the U.S. session. You are also dealing with a lot of FX cross currents off of those central bank decisions this morning. What does that mean for the futures picture? Well, it does mean a little bit of green on the screen. The party continues on this side of the Atlantic, at least when you look at futures. Eurostock 50 futures higher by 1.2%. The FTSE 100 higher by about the same amount, higher by about 1%. What that tells you is that read across from the States is continuing into the Asian session and Europe as well. But take a look at what you're seeing even in the U.S. Traditionally, when you see those record highs, futures trading, at least in Asia and Europe, tends to pull back on that rally. This morning, you were seeing the exact opposite, higher by 0.4% on the S&P. A little bit of a defensive tilt to it, given that the Nasdaq is higher by 0.7%. But it really speaks to this idea that the party is continuing to go on, simply because even though you are seeing these inflation upticks, the idea of rate cuts on the horizon has not changed at all. That's the equity story. Let's talk about the bond market story as well, because even though we're talking about these rate cuts on the horizon, remember, Fed pricing ahead of the meeting had really changed anywhere from 3 rate cuts to 2 rate cuts. So if you get a quick check on the bond market, that's really where this story, I would say, has a little bit of dislocations, because so far the bond market and the FX market have actually been a little bit uncorrelated. You have seen this divergence. Any moves in the bond story has actually not translated into the FX story. And this is a really big piece of the equation when you look at that 10-year yield, 4.27 unchanged at the moment. But that's interesting given that you are starting to see those rate cuts getting priced in. Euro dollar at 109, cable at 127, stronger a little bit on both of those European currencies. Dollar Swissy, by the way, unchanged. When you start to talk about these FX stories, a lot of it has to do with, again, the Fed change. But again, how much of this really puts the onus on the central banks that we're going to see later today? At least that's the story here in Europe. Let's see what the story is in Asia. Avril Hong has that story in Singapore. Avril, walk us through it.
Yeah, Kriti, we're seeing the Fed tone as well as those dots really helping the assets across the region. EM Asia FX doing well. Korean won outperforming, and it's moving towards that 1320 level. We're seeing tech, cyclical stocks running quite nicely today as well. And the gauge for stocks in the region climbing by the most in 4 months, hitting roughly the highest level in about 2 years. Gains from Tokyo to Seoul. And you're seeing the Nikkei, I believe this is a fresh closing high. It was on holiday yesterday. It's really going great guns today. Let's flip the board, because if you talk about tech, it's not just about the Fed, it's also that AI theme and the idea that we have the chip sector doing pretty well amid all this, especially after Micron surprised with its revenue forecast overnight. And Samsung Electronics, SK Hynix, these are the companies that Bloomberg Intelligence thinks will show their sales recovery in the first half of this year. Let's flip the board, because then the question also becomes, for the tech-heavy indices in the Asia-Pacific, where do we go from here? And for the Kospi, it used to move pretty much in tandem with the Philly Semiconductor Index. There's been a bit of a divergence of late, and given how we're expecting chip stocks to perform, maybe it's time for it to play catch up. Let's flip the board again, because I want to take you to dollar yen. We saw how earlier in the week the BOJ and UEDA pushed it towards 152. Now the Fed and Powell pushing it back down to roughly the 151 level. Kriti.
Avril Hong in Singapore walking us through that story. And it felt like the onus went from the BOJ then to the Federal Reserve. Avril again pointing to how you are continuing to see that kind of transition filter out through the FX story. And that's just one currency pair. There's plenty more to go. It all comes down to the inflationary story, especially because on the surface, take a look at what he's kind of talking about. A lot of hawkish rhetoric around the inflation print, but then a little bit of a dovish pivot when you're talking about how the market's interpreted. Yet that kind of overhang that you're going to see really comes down to those hot prints that we saw in the last 2 months. Take a listen to what Chair Powell had to say.
The January number, which was very high, the January CPI and PCE numbers were quite high. there's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations. I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road.
Take the two of them together, and it hasn't really changed the picture. Those are the words from Chair Powell over the Federal Reserve in the face of some pretty consecutive hot prints. How's the market interpreting this, though? Let's get a little bit more analysis here. Ven Ram from Bloomberg's Markets Live team joins me this morning. Ven, on the surface, this to me seemed a little hawkish. You saw moves in the dots. You saw the idea that they are still talking about some of these inflation upticks. They're not as rushing towards cutting as perhaps they were, or at least it seemed like they were in their last press conference. What did you make of the dot plot in particular? Then we'll go into the nitty gritty of inflation.
Morning, Kriti. I thought that the dot plot was an impossible effort to square a circle by the Fed. On the one hand, they said that the jobless rate is going to be lower this year. They said that core PCE is going to be sharply higher than they were expecting in December. And they also pushed up the GDP growth forecast for the year all the way from 1.4 to 2.1%. Now, 2.1% is a pretty magical level. If you think about the long-term trend rate in the US is about 1.8%. So they think that we are going to get above trend growth. The labor market is going to be pretty strong, and then inflation is also going to be ticking higher than they thought. And then here they go and stay with 3 rate cuts that they penciled in December. So they're trying to square that circle, which is impossible. And which is why we heard Powell make those remarks in the press conference. And he was pretty evasive when he was asked pointedly about why they stayed with 3 rate cuts rather than 2. And he was pretty evasive on that question. So the Fed is probably thinking that rates are too restrictive here and they want to get it lower, even though the economy is not offering them the excuse. The Fed is, in fact, fighting the economy at this stage.
Well, it's interesting that you're saying kind of they're fighting the economy at this stage, because if you look at the bond market reaction, again, I think when you look at some of the nitty gritty, it seemed like initially a hawkish take, and yet the bond market interpreted it as dovish simply because they were sticking to that 3 rate cuts. Ven, talk to us a little bit about the bond market reaction in particular. It feels like there's a trend that on every Fed day, no matter what the data suggests, whether there's an uptick in inflation or whether some of the rhetoric seems a little bit hawkish, the bond market always catches a bid. Why?
That's because, Kriti, I mean, the markets have to take the Fed at their word. I mean, here's the Fed, as we said, despite all the inputs that are coming in from the economy, they're insisting that 3 rate cuts are on the table, and it's the job of the markets to take the Fed at their word, not to fight the Fed, and that's what the markets are doing. But if you look at the rally in bonds, it's not too emphatic. I mean, we have come lower on the yields, but not by a whole lot. And particularly the 10-year hasn't rallied a whole lot. And, what the Fed did was also raise the neutral rate. I mean, that's the first time in a long time that they've raised the estimate of the neutral rate. And that suggests that interest rates are going to be higher for longer, which is why I think that the inflation premium attached to the longer end is going to be higher. And that's going to keep yields stickier at the longer end, albeit it may not be visible in the price action today and tomorrow, but come in the fullness of time, come probably next week and the weeks to come after that, I think that the markets will start reflecting those jitters.
It's interesting that we talk about the fact that the bond market perhaps hasn't moved that aggressively, but it kind of is doing it in slow motion. The fact that we're looking at 4.27 on the 10-year yield right now, really fascinating. Bloomberg's Ven Ram, thank you so much for your analysis this morning on this day after the Fed. Now the focus shifting to the BOE. At least that's one of the central banks we're watching. The S&B, Norges Bank, of course, reporting later as well. We're going to dive into the analysis later in the show. But for now, let's zero in on the UK story. Our UK correspondent, Lizzie Burden, joining me now this morning. Lizzie, ahead of this week's central bank palooza, a lot of people said that both the Fed and the BOE are going to be a little bit of a snooze fest. Tell us why it might not be this time around.
The BOE Critty is never a snooze fest. Yes, it might hold rates at 5.25%, a 16-year high, but I would look to the dot plot for some more excitement. Maybe we'll get another three-way split, but maybe this time it'll be a little more dovish. Maybe you'll see Jonathan Haskell dropping out of the hawkish camp and leaving Catherine Mann, the sole voter for a hike. You did get that UK CPI data yesterday. That's going to be crucial to informing this decision. You had good news on the headline and core levels, beating better than expectations, but on the services front, not such good news. And that's a worry for the BOE, of course, because it speaks to domestically driven inflation. So really, today, it's all about clues as to the future path for rates. And City economists say that Andrew Bailey's already left it too late. They recommend positioning for cuts as soon as May. Off the back of the data, you did see traders changing their bets, but still pretty much in line as where they were before. A third cut still on the table. But as I say, Bailey not likely to give too much guidance on the timing today.
Lizzie Burden, we thank you so much for bringing us that analysis this morning. And of course, we're going to be watching the FX story and the cable rate off that. Let's talk a little bit about what else we're getting on the day ahead as well. Because, look, Lizzie talked about why the BOE isn't a snooze fest. I would argue all eyes on the S&B this morning. That coming up at about 8:30 a.m. London time. And, of course, remember, a lot of the market positioning here is going to be short the Swissy. And so the market story, the FX read-through is really significant. We're going to explore that theme throughout the show. At 9 a.m. then, you have the Norges Bank decision as well. Look, we don't give a ton of emphasis, I think, to the Scandinavian nations, but you should, especially in light of some of the oil markets or lack of oil market moves that you're seeing. Remember, Norway is going to be directly impacted by that. 9 a.m. UK time. A very different story from the S&P, a very different story from the BOE. But do those commodity-exposed economies then have or create some sort of precedent for the other global economies in the world? And then we go, of course, from central bank decisions to perhaps some of the investment banking decisions. That long-awaited Reddit IPO is due to debut today in New York, I should say. And remember, this is a lot to do when it comes to simply the idea of whether or not this opens the floodgates for other IPOs. Remember, you've had these kind of tech companies that have IPO'd and then not performed that well in the days after. Does Reddit follow that trend or break it? It looks like those are getting priced at about $34 a share at the moment from the current guidance, raising about $748 million, in that initial story. And it's not the only IPO news that's on our radar. Just moments ago, we are getting headlines, this time on the IPO space, not in New York, but in Dubai. Get this, Dubai's Parkin jumping on their debut, $429 million IPO, which, again, in the context of what you might see in London or New York, isn't that big, but it is a record. It marks a record for Dubai. This is a public parking business that's seeing huge demand, getting this, attracting $71 billion in orders. The IPO getting 165 times covered and oversubscribed. So again, that massive move there. Intraday, you're already seeing a jump about 26%. We're going to, of course, keep you apprised about whether that's a Dubai story, a stock-specific story, or indicative of perhaps another realm or another success story for the IPO. Lots to talk about coming up later on the show. Our exclusive interview with the World Trade Organization's chief economist, Ralph Ossa, joining us now for a deep dive into the state of globalization. That coming up shortly. Stick with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. I'm Kriti Gupta in London. Let's get some of the other stories we're watching from around the world. Bloomberg has learned that Barclays is preparing to cut several hundred jobs within its investment bank division. This comes as the company embarks on a years-long effort to trim costs and boost profits within the unit. And sticking with the banking space, Bloomberg also understanding that Citigroup reducing its investment banking headcount in London, roughly 20 employees affected. Now, the bulk of the cuts are likely to include junior staffers in the analyst to director levels. And sticking with corporate news, the U.S. Justice Department is said to be poised to sue Apple as soon as today for violating antitrust laws. Apple has been accused of blocking rivals from accessing hardware and software features of its iPhone. The DOJ has already sued Google for monopolization, while the FTC also pursuing antitrust cases against Meta and Amazon. Boeing has predicted a massive cash drain for the first quarter as regulatory scrutiny and slower output of its 737 MAX takes its toll on the company's finances. Boeing's free cash flow will be in the low single-digit billions of dollars for the full year. That's less than the $5 billion expected by analysts across Wall Street. This as the company grapples with the aftermath of a mid-air incident earlier this year. Micron Technology shares have soared in late trading in the U.S. session after it gave a surprisingly strong revenue forecast for the current quarter. Buoyed by demand for artificial intelligence hardware in line with some of the other tech names we've been watching, the largest just U.S. maker of computer memory chips says that fiscal third quarter revenue will be between $6.4 and $6.8 billion, topping the $6 billion penciled in by analysts. And finally, Birkin handbags just too difficult to buy. That's the contention of two shoppers in California who are set to file a class action lawsuit alleging Hermes is breaking U.S. antitrust laws. The complaint saying the company requires potential buyers to purchase thousands of dollars of other products just for the chance to access those coveted leather bags. Plenty more ahead. Our Terms of Trade segment is coming up. We're speaking exclusively to the WTO's chief economist. This is Bloomberg. It's time for our Terms of Trade, our weekly dive into the state of globalization. Consumers have been pretty resilient in multiple parts of the world, but how long can that last in the face of geopolitical tensions, election risk, protectionism, and, of course, tensions in the Middle East? There's a lot to talk about when it comes to the impact on trade. I want to bring in our exclusive guest this morning, Ralph Ossa, the chief economist at the World Trade Organization, joins me this morning. Ralph, a pleasure to have you on the program. Thank you so much for joining us. Let's start with the story about globalization. Good morning. We're hearing a lot about this idea that we have a lot of election risk. There's a lot of bringing manufacturing capacity onto U.S. shores, onto Chinese shores, into Europe. These ideas of deglobalizing, how much of a risk is it going into, I think, 50% of the world's elections this year?
So when we look at the data, we don't see any signs of deglobalization, or at least not any signs of any massive deglobalization. But what we do see is first signs of fragmentation along geopolitical lines. You mentioned the U.S., and if you look at trade between the U.S. and China, for example, what we see is that the trade between these two economies is going by 30%, is growing 30% slower than trade between the U.S. and China and other economies, for example. So there's a shift in trade shares away from China and the U.S. So that's one way in which we are seeing this fragmentation. But you also see it more broadly. So it's not just a story about the U.S. and China. One thing we've done, for example, in our analysis, we've separated the world into two hypothetical geopolitical blocks based on voting patterns at the UN General Assembly. So one block of countries that tends to vote with China and another block of countries that tends to vote with the US. And what you see, if you look at the data, you see that the trade within these blocks tends to grow more slowly now than trade between these hypothetical blocks, again, adding to this overall picture of first signs of geoeconomic fragmentation.
Well, as we talk about that fragmentation, what is the read-through then on the consumer? Do you see some sort of decrease in shipping activity because everyone's kind of doing their own thing? How does that serve or not serve the global economy?
Well, it's not so much everyone doing their own thing, so we don't see so much home shoring. We really see a shift in trade patterns, I would say. So from the US perspective, for example, not importing that much anymore from China, instead importing from other countries, Mexico, Vietnam, and so on. I mean, one interesting pattern that we're also seeing in the data is, to some extent, there also seems to be a diversion of trade flows. For example, Mexico is importing more from China, and then the US is importing more from Mexico. So it appears, at least, that some of these trade flows are also just being diverted.
So we're talking a little bit about kind of the North American sphere. I want to bring it right back here to Europe and to the Middle East in particular. As we talk about kind of some of the tensions around the world, we talked about the election risk. We're also talking about geopolitical tensions in the Middle East, in the Red Sea. If you talk to corporate CEOs over and over again on this program throughout Bloomberg Television, the theme seems to be we're not seeing a read-through just yet, that the kind of trauma of the post-COVID era, the supply chain crunches there, have created some sort of resiliency in supply chains as well. How long does the conflict in the Red Sea need to go on? Where do you start to see a breaking point in some of these supply chains?
Yeah, so first of all, let me say that's also my assessment at the moment. Even though the Suez Canal is of course, an important trade route, we also don't see any major effects so far, other than, of course, that a lot of trade has to be diverted. For me, the main risk to look out for really is whether the conflict escalates and whether this is going to start affecting energy markets. Because if you get that, then of course you can have a more important knock-on effect on the economy. But I think the reason international trade is coping quite well, or is quite resilient to this shock, is because we have a good amount of shipping capacity at the moment. So the constraints in the shipping industry are not what they were during COVID. So shipping companies can absorb this extra work that they have to do by taking the longer route at the moment.
So resiliency, sure, in shipping and that in terms of excess capacity, but a lot of the ways that this is tackled is done through excess fuel, excess labor, rerouting around the Cape of Good Hope, among other ways, rail lines, for example, getting more traffic as well. A lot of those costs are passed on to the consumer, though. So in this era where you are seeing consumer resiliency around the world and strengthen the economies, that makes a lot of sense. If this conflict lasts years, for example, and you see the same issues passed on to a consumer among a weak economic backdrop, would that see a bigger result?
Yeah, no, of course it's not helping, and it's especially not helping Europe. I mean, one thing that we've been seeing, of course, is that the US has been doing better than we expected. Europe has been doing worse than we expected, and as a result, global trade has also been doing worse than we expected. And of course, these tensions that we now see in the Red Sea, I mean, they affect the whole world, but they particularly affect Europe. So if this is going to last for a long time, at some point, you're also going to see it in European consumer prices. But at the moment, in a way, the weak demand in Europe is helping because they at this point at least import demand is not so strong anyways. So of course the demand for products that go through the Suez Canal is also a little bit less than, for example, we saw towards the end of the COVID crisis.
Ralph, a final question to you. I'm putting you on the spot in about 30 seconds. We're talking about this import demand being fairly weak. Let's talk about the currency impact as well, coming out of China, out of Japan, out of Korea, that are still really dependent on those export revenues. What is your read on the currency impact on the global trade situation? 30 seconds, if you can.
So we haven't, the currency impact is really not something that, we're analyzing in depth. So I don't think I can share any interesting information here with you. I can talk a little bit about China, and what we've seen at least is that China has been holding up relatively strongly. At the beginning of the year, there were concerns, or even towards the end of the year, of course, there were concerns about the property market in China and how this would affect Chinese growth and Chinese trade. But at the moment, that doesn't seem to be affecting the global economy too much. So what we are really looking at the moment is the situation in Europe.
Understood. Ralph Ossa, the chief economist over at the World Trade Organization, joining us this morning for an exclusive interview. We thank you so much. Coming up on the program, as EU leaders meet in Brussels to discuss support for Ukraine, the nation's prime minister says military recruitment could be scaled back as more aid arrives. We'll bring you more from that exclusive conversation with us next. Stick with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Kriti Gupta in London. Let's get to the top stories that set your agenda. Powell keeps the party going. The S&P 500 hitting another all-time high in the U.S. session as the Fed maintains its outlook for 3 U.S. rate cuts this year.
If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
Now the spotlight on the Bank of England, also expected to announce a hold later today, allowing a little bit more time for those inflationary pressures to cool. But it's Switzerland's national bank that could be the surprise. A handful of banks eyeing a possible trailblazing rate cut, not to mention what we get from the Norges Bank as well. A lot to digest. Let's get a quick check on the markets ahead of what's sure to be an action-packed next 24 hours. When you look at the futures picture, you are seeing green on the screen. The record that you saw in the States continuing in the European and the Asian sessions. Eurostoxx 50 futures higher by about 1.2%. The FTSE 100 right on its heels, higher by 0.8% as well. Traditionally, when you see a record high in the States, you see a pullback in futures. You are not seeing that today. Some outperformance in the States. The U.S. futures, S&P at least 0.44%, 53.09 on those contracts. Some outperformance, though, in the defensive space. NASDAQ 100 higher by 0.8%. That's your equity picture. Let's get a quick check on the bond market as well, because that's where you're supposed to see more of the monetary action. Now, it looks like it's flat on your screen right now, but if you look at an intraday chart, 426 is where we are on the 10-year yield. You saw a massive bid into the bond market after the Fed pared back only in the last 30 minutes or so when you look at the market. The FX story is the focus this morning, though. Eurodollar 109, cable at 128. And, of course, we're keeping an eye on what that Swissy strength actually looks like this morning, a bit stronger ahead of the S&B. That is your central banking story and the market story. Let's get a little bit of the geopolitics here. Ukraine's prime minister says that the military might recruit fewer than the 500,000 troops than it originally planned. Speaking exclusively with Bloomberg, he said that blocked U.S. funding could arrive as early as this month.
So we have assurances from United States Senate because they approved this draft law. So now we are waiting decision of Congress. We have very active dialogue and negotiations with many congressmen from both parties. We have bilateral and bipartisan support from the Congress, and I believe that during the nearest time, this month or maximum next month, we will have this good news from United States, and United States will join to European Union, to G7 coalition. Military and financial support of Ukraine in this battle with Russia.
The rhetoric changing here in Europe. We heard Emmanuel Macron, the president of France, talking about potentially boots on the ground in Ukraine. We hasten to add that that's not something that Ukraine has asked for. But do you take a message from that? Is there more urgency here in Europe? And also, would you welcome boots in Ukraine from Europe, even in non-combat capacities?
I should say that for the last 1.5 years, maybe 2 years of full-scale aggression, mindset of many European politicians is changed dramatically, and it's very good news for all of us because we understand that Russia is aggressor, is terrorist country, and Ukraine now is protecting European borders. So we are very glad that President Macron communication is much stronger. It's very concrete, very clear, and this is what we all need, not just Ukraine but all European Union. We should be very concrete, very fast, very clear, because the only way to fight and to liberate in this full-scale war with aggression of terrorist country such as Russia.
Ukraine's prime minister speaking exclusively to our very own Oliver Crook. Ollie joins me now this morning from Brussels, where, of course, EU leaders are meeting today to discuss key issues, including security, defense, and spending. Ollie, good morning from London. Let's talk a little bit about the story around freezing Russian assets. How are EU leaders approaching it?
Yeah, so I think this is going to be one of the most critical points that they're going to be able to talk about and try to make some progress on, which is these 260 billion euros that are being held right now by the G7, 200 of which are being held in here in Europe right now. And they're all throwing off about 3 billion euros a year. So there's the short-term needs of Ukraine, which are ammunition, long-range missiles, that sort of thing. But there's the longer-term question about how to fund Ukraine, how to get money to Ukraine, which is obviously a critical issue both in Europe but also in the United States, judging by the fact that that $60 billion package is still stuck in Congress. So one of the ways that they're thinking about doing it is tapping some of these Russian assets, the profits from them, and bringing them directly to Ukraine. The issue is within Europe, you do not have unanimity on that. You need that. So they're thinking about maybe fudging it where they say about 90% of it will go to weapons, 10% will go to reconstruction because some of the member states are less comfortable with funding military equipment directly. But there's also another idea, and this came up with the Ukrainian Prime Minister. Have a listen.
Now, European Union have made first step, confiscation of revenue of these frozen Russian assets and usage this for Ukrainian needs, for urgent Ukrainian needs. And we believe that this is only the good sign and only the first step. And we continue discussion how legally and politically organize this confiscation of frozen Russian assets.
And so the conversation right now in Europe is about the profits from those assets, but what he's talking about is seizing the underlying assets themselves. We're talking about €250 billion worth of assets, which would obviously fund Ukraine for a long time. It's not a surprise that the Ukrainians want that, but Joe Biden wants that, the U.S. wants that, and they want to make meaningful steps in progress in discussing how they could use those assets to fund Ukraine. There's resistance from that from the French, from the Germans, even from the ECB, saying that it could sort of threaten the euro as a reserve currency. And really, obviously, that's one of the pillars, not seizing private property in liberal democratic states. But again, if there's ever an exception for that, it can be in times of war.
Bloomberg's Oliver Crook live in Brussels for us this morning, walking us through that frozen Russian asset picture and basically what we're keeping an eye on. Thank you so much for bringing us that crucial reporting. I want to bring up some of the other stories making news around the world as well, especially in the geopolitical space. Ireland's prime minister has unexpectedly resigned, saying he's no longer feels he's the best person for the job. His coalition government suffered 2 heavy referendum defeats earlier this month, for which he took full responsibility. He'll stay on until a successor is chosen. And from Ireland over to the Middle East, the U.S. Secretary of State Antony Blinken will be visiting Israel later this week to continue efforts to protect civilians in Gaza. That is, if Israeli forces enter Rafah. Blinken is on his 6th Middle East tour since the war between Israel and Hamas had began. He's already met leaders in Saudi Arabia and is due in Egypt today. Now, coming up on the program, we go from the geopolitics back to the monetary policy. The Swiss National Bank due to make their first decision of the year, coming at about 8:30 a.m. UK time. Some banks say we could be in for a surprise cut. We discuss what that means for the markets next. Stick with us. This is Bloomberg. This is Bloomberg Daybreak Europe. I'm Kriti Gupta in London. Look, it is central bank palooza this week, and today it is all about the central banks and monetary policy in Europe. We kick it off with the BOE coming up at 12. We got the S&B, we got Norges Bank as well coming out throughout the days. That means there's going to be a lot of volatility in the bond market and the FX space as well. But let's kick it off, our coverage at least, with what to expect from the BOE. Our UK correspondent Lizzie Burden joining me now this morning. Lizzie, we had an uptick in some of the inflationary numbers when you look at what the UK CPI comes. How much of that changes what we expect from the BOE today?
Well, the services number wasn't what they wanted, but it was good news, at least in terms of the core number and the headline level of CPI yesterday. So on balance, maybe it doesn't change the picture, just encouraging news that inflation is moving towards the BOE's 2% target. So, Kriti, with that in mind, yesterday you saw traders raising their bets for rate cuts from the BOE, but not by much. They still see 2 cuts this year, fully priced, maybe with a third in play. But even then, City economists say that Andrew Bailey's already left it too late, and they recommend positioning for cuts as soon as May. Now, in terms of the decision today, if you think it's going to be a snooze fest, the place I encourage you to look at is the vote split. Maybe we get another 3-way vote split. Maybe we lose one of the hawks in the form of Jonathan Haskell, leaving Catherine Mann, the sole MPC member, to be voting for a hike this time. She's just had another term on the MPC confirmed. You are still, though, likely to see Swati Dingrat voting to cut. And if you see an even more dovish surprise, HSBC says that the pound's increasingly in jeopardy. Because remember, sterling's been the best performing G10 currency against the dollar this year on that higher for longer narrative. So if it's a dovish surprise, HSBC asks whether that can last.
All right, Bloomberg's UK correspondent Lizzie Burden walking us a little bit of a preview of what we can get from the BOE. She says it's not going to be a snooze fest. I believe her. We're going to keep an eye on it. Thank you so much for joining the program. It's not the only central bank reporting this morning. The Swiss National Bank is as well. And this is where it feels like a lot of the market is really focused because net, they seem to be short the Swissy when you just actually look at this expectation of a cut from the S&B. I want to get a little bit more context here. Bloomberg's Bastian Benrath joining us this morning from Zurich. Bastian, a pleasure to have you on the program. This is not the first time that the S&B has in the past and could potentially front-run the ECB or front-run the Fed when it comes to actually cutting rates. Walk us through the logic of doing that right now.
Well, the inflation is just lower than it was expected and significantly low. We saw 1.2% lately, and they expect an average of 1.8 for the first quarter. So this is definitely a strong case for them to lower rates. Also, the franc has lost strength since the beginning of the year. It reached an all-time high in the final days of 2023. Since then, it has lost strength, but there's still some residual strength in the currency. And since the franc is a haven currency, the S&B has always for a long time been focused on keeping the franc in check and keeping it from appreciating too much. So these two things could easily make a good case for them to do a surprise cut.
Talk to us then about, so we're talking about the surprise cut. We talked about the inflation picture. You mentioned the currency piece as well. We're going to dive into that a little bit later in the show. This is also coming after the recently announced departure of Thomas Jordan. Does that change what we hear from the S&B?
Quite honestly, Thomas Jordan is at least going to try that it doesn't, because he's just like a really old school central banker. He will focus on the monetary policy. This is the important thing for him. He will make sure that his succession stays out of the discussion. So if you ask me, I don't think it will have a big influence, but obviously Jordan will face questions, particularly about who will succeed him. Because due to common practice, it was always the case for a very long time that the vice president of the S&B succeeded the president. So that would be Martin Schlegel this time. But he's not in the board for very long. He hasn't been there for 2 years. So he's still kind of a little bit out of experience. So we'll face interesting discussions about who will succeed Jordan. But again, he will focus on monetary policy, and even if he faces questions, he's very likely to deflect all of them and say, my personal future and will not influence the S&B. I will leave the house in good hands and everything will be fine. That will be his main line of reasoning.
Bloomberg's Bastian Benrath, our man in Zurich, we thank you so much for joining the program. It's a crucial decision, as Bastian just pointed out, especially when we talk about just kind of what this means for the market. Again, we're going to dive into that in just a few moments. I want to mention, though, that the S&B president, Thomas Jordan, that Bastian was just speaking about, will be speaking to Bloomberg after the policy decision, talking perhaps about his departure, talking about the economic outlook in Switzerland and the broader European economy as well. We're certainly looking forward to that interview. Stay tuned for that. In the meantime, a little bit more analysis on the economics here. I'm joined now by Sree Kochugovindan. I hope I pronounced that right. Our senior research economist over at Abrdn Investments. A pleasure to have you on the program.
Thank you for having me.
Let's start with the Swiss National Bank, then we'll go broader. The fact that they could front-run the ECB in terms of rate cutting, what kind of precedent might that set for other central banks around the world?
I think, to be honest, for most central banks, it will really be a case of looking at their domestic underlying inflation pressures rather than looking at relative to other central banks. So I think for the SNB, obviously, it's slightly idiosyncratic issues there in that they are looking at the strength of the currency. And there are now, even though the consensus is still for the SNB to wait, there are a few banks starting to look at a potential earlier cut, potentially for today. So that would be quite unusual, but obviously there are some idiosyncratic reasons there, in particularly the strength of the currency, which is, 7% higher than when they first started. So, yeah.
Well, that's kind of where I feel the precedent might actually come through, right?
Yes.
The fact that we have to actually start thinking about currency impacts, not just for the Swiss National Bank, but isn't this the exact issue that the BOJ is having as well?
Absolutely.
And potentially even the ECB, when we've in the past talked about the euro hitting or euro dollar, for example, hitting 120. What do we need to know about the currency piece of the equation? How does it bleed into the economics?
I think obviously the channel there would be looking at the impact on inflation, but also the impact on domestic economy and trade and so on. I think for the BOJ, obviously that was quite an interesting dynamic there. We saw a historic moment this week. We saw the package of ultra easing monetary policy settings unwound. A broad range of measures, but not just a move to move away from negative interest rates. It was YCC, it was ETF purchases, etc. So that was very broad. But what did the yen do? It weakened, and I think that was quite interesting. A lot of this news was already priced in. The the changes from the BOJ were pre-announced in essence in terms of the media leaks. Yeah. So this had already been priced in to some extent. So there's a lot of speculation ahead of time. However, it's a very small move. It's just 10 basis points. And, you know, we still have a world of a very accommodative policy at the BOJ. And really, that doesn't make a meaningful change for the relative value of the yen to the USD.
It's interesting that you mentioned that currency pair in particular, because after the BOJ, there was so much emphasis on what the Federal Reserve would do. Yeah. Let's dive into that a little bit more, because to me, as we were listening to this press conference and the initial lines that came out of the actual statement itself from Chair Powell, my initial read was that it was a hawkish tilt, that they were saying that, look, inflation is ticking higher a little bit. We can wait for a little bit longer for cuts. It kind of felt like he was managing the message. When you look to the bond market, they dove right into the bond story. The bid there was quite dovish. Connect those dots for me here.
I think that he said a few things. My take was actually that he was a bit more neutral, because he did talk about, you know, potentially delaying or potentially cutting sooner. And really, again, it really depends on the underlying wage pressures, so services, inflation, what's happening with wages. And there are some... Obviously, there are some bumps on the road that they've decided to look through for now. There was a lot of talk about what happened to the core PCE, core CPI in January and February. Slightly bumpy path there. But those monthly numbers and quarterly numbers tend to be quite volatile. They can be distorted by seasonals. But if you look going further, we've seen a lot of improvement, obviously, in the last 18 months in terms of the inflation path. Some of that is goods disinflation, deflation. That's really base effects, commodity price base effects. That could be masking some issues in the labour market. The labour market has been incredibly tight. That trade-off between unemployment and inflation hasn't occurred. It hasn't been so bad. So ultimately, it seems that going forward, if we look at measures such as the Employment Cost Index, Atlanta Wage Tracker, these are all moving in the right direction. They are starting to show signs of wage pressures easing off. If you look at underlying components of core inflation, such as shelter, the leading indicators such as house prices and private sector rents, they're all looking at indicating a steady deceleration in shelter components. So it does look like we could see core PCE heading towards sort of 2.3, 2.5% later on this year, heading in the right direction, really.
So I love the nitty-gritty. I want to go into that. But you initially said that this was a neutral read. But for the bond market, it was dovish. Does neutral equal dovish now?
Well, I think when I was saying neutral, in terms of the signalling from Chair Powell, and I think it's also interesting, the signal from the dots. If we look there specifically, obviously we still have 3 cuts in the dots. However, if you look at the detail, it was quite a close call. So I think there you can see there's some disparity across the members, the FOMC members.
That's what I was going to ask next.
Exactly.
Because Lizzie Burden, our UK correspondent, had talked about this as well, the kind of division in the BOE. The fact that we're seeing division in the Fed now, does that make perhaps a little bit more sensitivity to each additional Fed speaker that we get? Just 30 seconds here, if you don't mind.
Absolutely, absolutely. And I think each additional Fed speaker, and also the data that's coming out, this is really going to drive whether there's going to be, there's a debate about whether it's going to be consensus is June, but there could be a debate whether it's delayed. And I think that's what the bond market was picking up on, rather than, even though Chair Powell was trying to be neutral and trying to suggest we'll look through this inflation print and we can still move a bit earlier. I think the overall balance there, the bond market was focusing on the dots and
I mean, I get it. We're all obsessed about the dots and the dot plot. We thank you so much. I could talk to you for hours. Sree Kochugovindan, I'm going to say that right, Senior Research Economist over Abrdn Investments. We thank you so much for joining us this morning. Plenty more ahead. We talked about the BOE, the Fed, the S&B, even a little bit of Norges Bank. We're going to dive into more of the details next. Stick with us. This is Bloomberg.
I think this is a signal, and the market is taking it as that they will tolerate slightly higher inflation for longer.
The threshold to cut rates is a little higher than many people thought, but also they're not talking about raising rates, even though they've had this higher inflation.
I think this is a Fed that really wants that soft landing to continue.
They also are not willing to, raise rates again, and I think that's important too.
So we still think we're going to cut rates this year. Timing's uncertain, and he said over and over again, it depends on the data.
It's really much closer to a two-cut scenario, but they didn't go with that at all, and neither did the market narrative.
The Fed's still committed to trying to get inflation down to 2%. But I think what's driving Powell is the fact that he thinks that monetary policy is restrictive.
Bloomberg guests reacting to the Fed's decision and comments from Chair Jerome Powell around really that decision that we got yesterday. Some would call it a snooze fest. Others would call it actually really changing the game when we talk about the inflationary story. There's another central bank I really want to zero in on, though, because, yes, there's the BOE, yes, there's Norges Bank, but it's the S&B I think that the markets are really paying attention to, especially when it comes to positioning. I want to bring you a couple of charts here and specifically talk about this move that we talk about in the Swiss franc. Look, you are seeing in terms of CFTC positioning, essentially leverage funds, how some of these net asset managers are actually positioned. You are actually seeing some of those shorts really built out. Now, they've been short for a while, but take a look at this. As we get closer and closer to that decision, that cost, that shorting is going up more and more. That's the positioning of this market. And that's why this cut, this potential surprise cut, is so important, because take a look at how it's showing up in the options market. That's where I want to bring you my next chart here. The cost to hedge against potentially that kind of a story for the Fed, it's getting more and more expensive. And this is why this is so important, because you actually haven't seen it get this expensive in about a year or even two, depending on what other pair you're looking at. And that's where you're looking at all this volatility in the Swiss franc. It's this right side of the chart I really want to focus in on, this spike in the line that you're seeing relative to the euro, relative to the dollar. And that's where it really speaks this idea that the market is looking for what the Swiss franc actually does in terms of carry, in terms of being that safe haven currency. Does the S&B now have to focus on that even more? That's going to be the conversation. That's going to be the themes that we explore in the next couple of hours across Bloomberg TV. 8:30 a.m. UK time is when the S&B decision comes as well. We're going to have an exclusive interview with Thomas Jordan over at the S&B. We're also going to be hearing from the BlackRock Vice Chairman Philip Hildebrand coming up at about 9 a.m. UK time. A lot to digest. Don't go anywhere. Guy Johnson and Edward joining me in just a few moments. Up next, Marcus Today. This is Bloomberg.